Welcome back to another episode of Freedom Finance with Lanny, guys. Thanks for tuning in. Appreciate the stop by as always. Make sure to hit the like, subscribe to this channel, guys, because you're here to help better your finances, to listen to me talk about my experiences, my knowledge, my expertise, my background, to hopefully help you on your personal finance journey. Today's video is going to be another hit 'em hard, hit 'em with the truth, real talk from Lanny. It's about simplifying your wealth, simplifying your finances. And specifically today, it's going to be focused on the taxable individual stock account. Now, you may not have one. Maybe you have a Roth, maybe you have a 401k, or both. So the taxable account is what we're going to focus in on here, and how, at least I found out, I'm in a situation where it's a little confusing, it's a little messy, and I want to simplify my individual taxable account. And I'm going to tell you how I got there to this messy situation, what I plan to do here in 2024, because maybe you're in that same situation. It's all about making things easier. It's all about simplifying so you can maximize not just your money, but maximize your time that you spend on investing, so that you can open up that time to do more things that you love and enjoy, guys. So grab your beverage today, guys. I got water, but you might have beer, your wine, your liquor. And guys, yes, definitely get that espresso. Match it up with the wine. Maybe espresso in the morning, wine later on, because you're Italian this weekend. Guys, you know the drill. So let's get into simplifying some of your finances, simplifying the individual taxable stock account. My situation to hopefully help yours. Let's get it. I put out a tweet earlier tonight, actually, about a confession here. I've been investing, like I said, for almost 15 years. And the confession I had is that I own 74 individual stocks or ETFs in my individual taxable account. And again, the taxable account is what you usually will juice up, invest into, to use that to get to financial freedom faster. My goal after all the retirement stuff is to focus on the taxable, because that's what you're going to be able to use now, tomorrow, and forever. And I found myself over the years building up stock positions, guys. I'm up to 74, like I just said. I do not recommend that. That is not advice. I'm now going to listen to my own advice. So it's messy. So I'm going to tell you how I got there. You guys maybe you're in the situation. As you're investing, as you're using your stock screener, I know in my case, it's not like I was born into wealth. Heck, I was born completely opposite of into wealth, completely poor. And when I wanted to invest, typically I would, scrap every dollar I could to make a stock purchase. Even when I was working in my career, it's not like I was making, hundreds of thousands of dollars in public accounting. So, I was buying small lots of stocks, right? And when that happens, typically some of these stock positions might be small. And as I was looking through my list of the ones that are below like $1,000, majority of the ones, it's either because of a spinoff or because I just made a small investment. So you might have found yourself doing that as you're starting your journey. Maybe you're a beginner investor, maybe you're in the middle of your journey, but you found a stock. This is the real situation. You find a stock that's undervalued. You have a few $100s, maybe it's 200, maybe it's 400, maybe it's 600, and you invest into that stock, right? You're like, okay, I feel great. That was maybe your 15th position, maybe it's your 20th position or your 10th position. The stock rises, you don't ever invest again, years go by, and you've done a lot of that same thing along the way. Another stock was undervalued, you put a few $100s because that's what you could save, that's what you had in the investment brokerage or in your savings account, and you just keep buying these small positions. And if you've never been able to reallocate capital again to those stock positions, these positions stay relatively small for a long time. Now you might get the big swan event where you're 10x in your investment, but typically that's not the case. Typically they might go up a little bit every year. They might have just stayed flat. hey, maybe like me, you're in some dog positions as well, some stocks that are down a ton. Um, and then next thing you know, you fast forward 15 years later, your name is landing, you have 74 of these tickers in your dividend individual stock spreadsheet. And you're like, this is just getting out of hand. Now, along the way, I've also owned so many companies that have spun off part of their division. Typically, they do that to maximize shareholder value for their shareholders. And as a shareholder of stock A, you now have stock in stock A and you have stock in stock B, the spinoff company. Now, typically, they try to tout that the spinoff company can operate better by themselves. And, I'll say this, for the majority of the ones that have spun off, they typically don't do well. And that's a lesson for me for the next time to completely just dissolve it or sell it right after I get it. Some great examples are AT&T with Warner Media Discovery. Should have dumped that right when that came out. IBM with Kyndryl. I've owned a few oil and gas companies that have spun off constant small entities. So you kind of end up with these other positions without you even knowing it. So here I am. It's February, 10th. I'm recording this. I've got 74 tickers, and that's how I got here. Making small investments, not adding anything more, stuck, and it's getting a little too complicated for me. It's taken my time to research how these stocks are doing, to stay within the news, to keep track of everything, and also some of them may not even fit my strategy, which is dividend growth investing, buying a dividend stock or an ETF that not just pays you an above average yield, but grows that income every single year. So we're going to talk about kind of what my plan is now, what you can do about it. And here's the approach I'm taking. I went through, I filtered out every ticker that I own that was less than $1,000. It might seem like a lot still to everybody, but after investing for 15 years, saving a ton of money in investing, an under $1,000 position is not that large. And, I looked at it, I've got about 12 of them. I own 12 positions that are under 1,000. And heck, I'm looking at my spreadsheet right now. I don't know, maybe a little less than half, maybe 3 to 6 of them are below even $500. So it's like, what am I doing holding on to this? Not to say crap, but these tickers, guys. So that was step one, filtered out everything below 1,000. And then I went to my real unrealized gain or loss. So am I in a loss or a gain position? Is it long-term or short-term? Thankfully, every single ticker here is actually in a long-term capital gain or loss position. The reason why that is nice to know is because from a tax standpoint, you can carry part of your losses if it's over, certain a dollar amount every single year. You don't need a capital gain to offset a short-term capital loss then in my situation. And long-term capital gains, if that ends up being the case, are, reported for tax purposes at a preferential, capital gains tax treatment. Long-term capital gains tax rate, which is what the dividend tax rate's also based off of. So a preferential tax treatment, guys. And, after summing the market value of it all, I've got about $6,800 through these 12 positions. And so the plan, again, listed on all the tickers, looked at the tax situation. And then I looked at the dividend yield, the income it provides, as well as what the 5-year performance has been like. And essentially, then I try to get a little scientific with it to say, okay, which gains and losses can I pair off? Can I net out to zero? And in fact, I found about 6 out of the 12 that I can net out to about, let's call it about $30-something here. So I can sell and get around $2,700 worth out of 6 positions at a 32 long-term capital loss. I'd lose $50.50 in income. It's a yield of about 1.85% from looking at my spreadsheet, guys. So 6 positions, $2,700, $32 long-term capital loss, $50 of income that those 6 positions provide me. Not a lot, right? I mean, the S&P 500 yields around 1.4 to 1.6%. My VYM's over 3%. So you already know I can do better. And keep in mind, these are mostly individual stocks. Can't even say dividend stocks because some don't even pay a dividend. To talk about it, I'm going to put the whole chart of the 12. You're going to see it. That is the 12 stocks, guys. Those are the 12 positions that are under $1,000 that I'm mulling selling here, in the near term or over the next year or so. But 6 that I might do right now, and those ones you'll see here are highlighted in green on the loss gain side of the chart. The ones that are highlighted in yellow are the ones that I really want to get rid of. The ones that are unhighlighted, though, I might keep and just continue to monitor because, like, for instance, Eaton Corp might break 1,000. There's a few that are getting closer to $1,000 position that I've actually, might have performed decently well, that actually grow their dividends and pay a dividend and all that's good stuff, right? That actually matches my strategy. Now, so that was all my steps right there. I did the filter, looked at the income, looked at the gain loss situation, and then looked at how can I maximize the opportunity to have a very minimal tax implication here. But now once you've done that, again, I'm at 74 and 12 is 62, but I'm only going to get rid of 6 more than likely. So that's 68. Cracking below 70 is definitely a big head start, right? But after you sell stocks, what is the next move? You have to know and plan for the next move. My goal is to match or exceed the dividend income and to continue to have growth from that income source. So you better believe I'm going to be allocating quite a bit more than likely to the Vanguard ETFs, the S&P 500 VOO, Vanguard's Dividend Appreciation ETF VIG, and Vanguard's High Dividend Yield ETF VYM. I'm also going to trickle in a little bit of Main Street Capital more than likely, ticker symbol MAIN, about $250 worth. And then the remaining is really going to be broken up through the Vanguard ETFs. So I'm taking away and getting rid of 6 positions more than likely and allocating it to 4 tickers that I currently and already own. So I will literally be at a net positive difference here of removing 6 positions. Now my goal is to get down to hopefully 50 positions over the next 12 to 18 months, barring market conditions. But at least this gives me a huge head start. This is almost taking down, I really wish I could get rid of 7, but let's just say 6 is almost 10% of the tickers in my portfolio here that I'm minimizing. But that is how this happens. So if you're in this situation, let me know what you do when you realize you have too many ticker symbols. Do you refuse to buy more stocks and ETFs to your portfolio? Do you keep it simple to simplify your wealth, to simplify your finances, to simplify your individual stock account? Definitely let not just me know in the comments, but the whole community that does watch this video, guys. This is what I'm doing, but I would love your feedback too with my plan, with what your take is on owning 74 dividend stocks and ETFs. Am I crazy? Let me know, guys. Again, subscribe to this channel, like this video. I know another real proof is right here of what I'm doing. I'm giving it to you guys straight and 100% real on this channel because I'm hoping my situation helps with your situation or my mistakes helps you avoid them, guys. Again, like I said, like, subscribe, and I'll catch you on the next one.